Today on my Switzer.com.au website, I wrote a piece called Vote Labor, Build Up Your Super, Kick Them Out. It was not my idea, but it was a friend who thinks he has been screwed by the government's super changes. He wanted to sell his business and build up his super, but now the non-concessional caps have been limited to $500,000 and backdated to July 2007. And it stops a lot of people building up their nest egg for retirement. Though Labor will tax super more harshly, it has not promised to stopping us putting $180,000 a year or $540,000 in one go to cover 3 years. So if Labor wins the election, my friend and his wife could get $1,080,000 into super in one go. Under the coalition, they could get $1 million in, but nothing if they've already used up their $500,000 cap since 2007. I received an email from someone who lent money to a family member out of their super, but when they put it back, or when they want to pay it back, he won't be able to put it back into his super fund under the coalition's $500,000 cap. He has nothing in super right now. The Treasurer should make the $500,000 cap start from this year, not 2007. That would be seen as a sensible move from the Treasurer, not a weak one. And remember, Queensland is the grand central of retirees, and there are 12 marginal seats in the Sunshine State. But that sunshine might not show up for the coalition on election day if their super mistakes aren't righted. Okay, in a recent AFR article, Christopher Joye said our house prices are going nuts. And in an earlier article, he argues that the RBA has lost the plot. So do we have anything to worry about, or is Chris just trying to scare us, you know, just to keep us sort of on our toes? Chris joins me at the desk. How are you, mate?
Yeah, good, mate.
All right. I'll talk to you about super if you've got a view on super, but maybe later. But I won't cover the issues you've been covering. Sure. And part of the reason is my old mate, and you're an old mate, Roger Montgomery, he put a piece out the other day which Fairfax jumped on, where he said the overhang of demand to supply for housing was worse than America in the subprime pre-GFC situation. You must have seen that.
Yeah, I did see that.
Did you agree with him?
Listen, I think the housing market is as strong as 10 men right now. Prices are up 4% in the last quarter alone. That's a 16% annualised rate. House prices nationally are up 10% over the last 12 months, and that's to 18 May. Yeah. Sydney prices are up 12%. Melbourne prices are up 13%. We've actually upgraded our forecast for 2016 we're expecting 6 to 10% growth this year. So house price growth, that is.
Nationally?
Nationally, yeah. And
what were you expecting before?
Previously, I was looking for 2 to 4% growth, and that was contrarian because you've got to remember, final quarter of last year,
it was slowing down, wasn't it?
Well, prices actually fell in Australia in the final quarter of last year, and there were a lot of popular pundits who were saying, listen, the housing market has turned, the boom is over. That, you know, I think one of Fairfax's economists was saying that there was going to be a crash in Sydney, and all these guys have been proven
Was he
wrong.
in-house or a quoted economist?
Listen, I don't want to misquote him, but I think he was the in-house economist and from Australian Property Monitors, but yeah, I think the housing market is building up some momentum, and I think the RBA's rate cut is quite profound because...
Is that why you said has the RBA lost the plot?
Well, the RBA's cut the cash rate to 1.75%, a new record low. In April 2009, they cut it to a record low of 3%, and then they raised it because they were worried about house price appreciation over 9 and 10. So by November 2010, it hit 4.75%, the cash rate.
That's when I was bagging the crap out of the reserve.
You were. We were arguing on this show. Let's not go back to that time.
It was fun. It was fun.
But by June 2012, Governor Stevens had said that the 125 basis points of cuts over 2011 and 2012 would not result in fast house price growth, would not result in another boom, would not result in an increase in household debt. Now, when he spoke those words, the household debt to income ratio was 166%. Today it's 186%, and today house prices are 38% higher. And this is unambiguously a result of monetary policy. So I think policy is too stimulatory. I mean, real economic growth in the year to March was 3%. It's probably above trend. The jobless rate has been falling. The issue here is we don't want to completely try and diversify away the business cycle. We actually do need bad businesses to fail and better businesses to rise up in their stead. And the economy has natural volatility that policymakers cannot seek to eliminate, because that's the creative destruction that is the heart of capitalism, that powers productivity, prosperity and growth.
So why do you think he cut on? I got to say, I always love an interest rate cut, but I didn't think he would, and I didn't think the economy really needed it. But I was hoping to cut
I actually thought he would.
Okay.
So I moved $15 million in our portfolio into 6-month term deposits at 3.2%, which looked great now with 1 point on the Friday before the Tuesday cut. So we thought.
Is that because you'd studied Glenn's?
I've actually got to say, since we...
Economically, you didn't think we needed it?
No. Yeah. So our trading positions are completely different to my economic views. Yeah. And in understanding the RBA, you've got to have a view on what you think the RBA will do. And then independently, you can have your own opinion as to what they should do. But they're two completely different things. And since we launched our first portfolio, we run 325 mil. And since we launched our first portfolio in February 2012, I think we've got, within 1 week of a decision, every decision right bar one. But the futures market on the day of the decision was down to...
It's just as unusual that you would boast that, Chris. I know you're not a boastful type at all, but that's a really good thing to boast about. But go on.
So the futures market on the day of the decision was pricing at a 45% chance of a cut. So the market was with you. Yeah. But listen, why he cut? I think he thought he could cut without kind of creating imbalances, but that's absolute BS. I mean, the RBA has created tremendous housing imbalances. I don't think house prices... Do I think the housing market's overvalued? Absolutely. Do I think house prices are going to crash in the next 12 months? No way. Are house prices heading higher, as I said they would in December, and in 2013, 14 and 15? Absolutely. But will there be a likely quite destabilising dislocation at some point in the medium term, when prices mean revert back to some semblance of fundamental fair value? Absolutely, and this is a real problem. So in the short term for banks...
Okay, but why did you... some people say, well, he wanted to bring the dollar down, which is a noble decision by a central banker. But you're saying, but he knew...
Well, the reason he cut was... I mean, it was very clear to me why he would cut. Because they've got 260 guys inside the RBA, analysts, and they hadn't moved for 12 months, and they get a sense of, I think, a relevance deprivation syndrome. Seriously, and the core. So
the economy is not the issue.
No. Well, they want to feel relevant, and he had an itchy trigger figure. But the key point was this: the core inflation print year on year was the lowest ever.
That's right.
Lowest ever. Okay, now, it was only 1.6%, the core inflation print year on year. It was only 1.6%. It was just below the 2 to 3% target band. Yeah. And you've got to remember...
And you don't believe we'll get another deflation?
Well, you've got to remember that when they forecast inflation, their 90% confidence interval for in 2017 core inflation is between, wait for it, 0.75% and 3.25%. They're 90% confident we've either got a huge disinflation crisis or an inflation crisis. They wouldn't know if their asses were on fire when it came to inflation 2 years ahead, right? So they can't forecast the future. They're the first guys to admit they can't forecast the future, but they're giving us the cheapest money in human history.
Okay, well, I want to pin you down on something, because you care about this sort of thing very closely. That's why you're here. When I saw the deflation figure, I said, well, the petrol prices dropped 10%, fruit prices down. I think the next one will not be deflation because the economy is not weak enough. I always equate inflation.
100% right.
Okay. So
what's the question?
Well, the question is then why did they do it? Why did he do it?
Yeah. So what he should have done is, we went through periods in the last 5 years where inflation was at the top end of the band, but he looked through that, as in the top end of the 2 to 3% band. But he looked through that. It was actually, right at the top of the band, and I think for a 6-month period there. And they made all sorts of excuses as to why that was not really important or material and relevant. We've had one of the biggest oil price shocks in history. And of course that's going to bleed through to some of those underlying measures of inflation, which I think it has, and on a second order derivative basis. And he absolutely should have looked through this number.
People would know what you're talking about, a second order derivative basis.
All that means is that there are first round effects and second round effects, right? Sure. The first round effects is petrol prices coming down. Right. The second round effects
the manufacturers with lower costs.
Yeah, the Uber costs are coming down, right? Yeah. So he should have looked through that inflation number, and it was a really reckless and irresponsible decision. And the housing markets reacted. I mean, auction clearance rates over the weekend, boom time levels. The market was meant to be decelerating and slowing. And one of the key reasons they cut in the statement, in the final paragraph, was that he claimed that regulatory measures to slow the housing market were starting to grip. Absolute BS. House prices are surging high.
There was probably, how many quarters was it where it looked like it was?
1 quarter. And he did the same thing. In June 2014...
And that was linked to it, the investors getting whacked by April,
in June 2014, I quoted this in my AFR article on the weekend, he got head faked by seasonality. In June, he saw the May data in June 2014, and he thought the housing market was slowing down. And he said, words to the effect, listen, if we got a period where house prices were to persistently grow at recent paces, like at the recent double-digit pace, that would be deeply worrying. And if the household debt-to-income ratio were to rise higher, that would be really concerning. Well, that's exactly what's happened. That was June 2014. We're June 2016.
Yeah.
Wake up.
But Chris,
the fundamental problem is this. The problem is this. In 1991, we had a recession, which was really heartaching for a lot of people, right? But that recession set up...
When?
In 91, we had a recession which was heartbreaking for many households and businesses. But one of the benefits of that recession, it's like a bushfire running through, the national parks. You get that regeneration, that organic growth. And for the next 15 to 20 years, we had very high rates of economic growth in Australia. The unemployment rate fell to the lowest level, in multi-decade history. We had very high productivity, and we didn't have high inflation. And
but
it was that
the
regeneration.
population copped tough reforms because the recession actually told them, just like the Banana Republic issue when the dollar fell, a lot of tough news can be good to make people accept stuff they really need.
Everyone knows. It's like sport. You put in short-term pain in order to get those long-term gains. And I think one of the mistakes the policymakers have made since the GFC is they want to eliminate all that downside. So they want to give us a 1.75% cash rate. They want to give us 3.7% home loan rates in order to encourage borrowing. The problem is we're funneling very scarce people and money into interest rate sensitive sectors of the economy, these leverage sectors that don't need that money, and that's highly unproductive, and so there will be long-term consequences, and that will be in the form of lower growth, lower productivity, and Chris, inferior living standards to what we could have had.
But what do we do when we have a massive mining boom that goes off the boil, and it probably could have sent us into a recession, or really low growth, and interest rates are falling around the world. Ours were too high there for a long time.
Well, now it looks like the Fed's going to hike in June, possibly. The Aussie dollar was a little high, but at the end of the day, we've got to trade off. It was only a little bit high, and we've got to trade off the long-term costs associated with funneling all this scarce money and people into commercial property, residential property, financial services businesses, anything that's leveraged, against the benefits of the counterfactual, which would be other businesses that would have survived and thrived and basically been the beneficiaries of that scarce capital and labour.
Okay, let's try and make some money out of your brilliance now. Okay. Will they cut again? Will they cut again?
Listen, I don't know whether they'll cut again. The current bond market, the 3-year government bond yield is about 1.6%, which implies that there's a good chance they will cut again. Certainly based on, I'm sure many folks on this show have said, the inflation forecast suggests they'll cut again. I think they're freaking mad if they cut again. They don't need to cut again.
Macquarie's got cash rate at 1%.
Macquarie does. In Macquarie's CMA, Macquarie's cash management accounts, one of the most popular cash savings accounts in the country, is only paying 1.65%. So you're looking at zero real rates. But if you want to make money, one of the most attractive opportunities in February was Aussie credit. What I mean by that is corporate credit, Aussie bond spreads on non-government securities, bank bonds, corporate bonds, were at the highest levels relative to cash rates, government bond yields and equity dividend yields that they've been since the global financial crisis, in some cases higher. And we've seen that asset class perform particularly well. We called, like I said in February, that this was a really attractive buying opportunity. We diversified our portfolio into those assets and took the opportunity to pick some of those investments up at cheap prices.
Does that include hybrids as well?
No hybrids. No, just investment grade debt. But the point is,
are hybrids too risky for your kind of bond?
We now, one of our portfolios we can invest in hybrids. We've never done so to date. I think Westpac's got a new issue, Westpac Capital Notes 4, which is being priced at about 4.9% to 5.1% above the bank bill rate. That'll give you a return of about 7%. The bank bill rate's at 2%.
Are you comfortable with hybrids?
Listen, we've called that market for the last few years, I think, very accurately in terms of the losses that have been realised. I think it's getting to a level now where, on a bottom-up fundamentals basis, it looks in isolation potentially quite attractive.
I'm starting to hear this.
The dividend yield on Westpac's ordinary shares is 9% grossed up, right? So you can take 9% by buying the ordinary shares, or you can take 7% from Westpac Capital Notes 4. The Westpac Capital Notes 4 ranks ahead of the shares. In most circumstances, it's safer than the shares, but it's not debt, it's not fixed income. It pays a dividend that's discretionary. It doesn't pay you interest. It's perpetual. It has no maturity date. There's an optional call date. But I would say this, that our estimates are the four major banks have to raise between 30 and 40 billion of additional Tier 1 capital, equity capital, over the next 3 to 4 years. They can do it. It'll be fine. And they will try and issue as much of this hybrid stuff as they can, because if it costs them 7% to do it, it's cheaper than issuing ordinary shares, and the total cost of issuing ordinary shares is about 10 to 11%. That's their cost of equity. So they're going to issue, so CBA did one a month ago. Westpac's announced they're doing one. NAB's announced they're doing one. And the problem is they can't raise this stuff overseas. They can only issue on the ASX.
Why can't they raise overseas?
Because they can't use their franking credits overseas.
Okay, good point.
So the summary is, listen, I think the hybrid sector is pretty good value right now in isolation, but there are technical supply headwinds.
Yeah. Well, a mate of mine said, I said, well, look, you're getting a nice return on these hybrids, but, I was saying the higher the return, the higher the risk. And he said, but when I buy a hybrid in Commonwealth Bank, if they don't come good on this, it's probably...
That's a BS argument.
No,
okay.
but this is a normal person.
Yeah, but let me respond to the normal person.
The normal person thinks that. If they think if CBA would have to go broke not to honour their hybrids.
That's the worst argument I've ever heard.
I will explain why.
Sure. So, and I'll give you facts.
What is that voicing normal people?
Sure. I hear this argument all the time. So, it depends on what your risk appetite is. CBA shares fell peak to trough in 2008, 2009 by 60%. If you're happy blowing 60%...
Great buy, they were too.
Sure. But if you're happy blowing 60% of your dough in a crisis and you're happy to weather that storm, that's fine, right? The hybrid, CBA Pearls 3 in 2008, 2009, fell about 40%. Right. So if you're happy when you're investing in a hybrid to lose 40% of your money in the next major crisis,
but it comes
that's
back.
Fine.
You don't lose it forever, do you?
Sure. So the hybrid went back to par value, so you recovered that 40% loss. Yeah. The CBA shares gave you, on top of the loss, as in they recovered back to par, they gave you a 60 to 80% capital gain.
But the point is this. You go back to my initial call. The person says, I'm prepared to risk this on the basis that if CBA can't stand behind its hybrid, it probably says that the whole economy is completely stuffed.
Agree with that. CBA is not going to go bust. CBA is not going to default on its debt. There are risks in a crisis the hybrids can get converted to equity, but then they rank ahead of equity.
But you can ride the equity out with it, as you made the point.
But the point made by your friend is a marketing argument I often hear with hybrids. The point the investor needs to understand is this stuff in a crisis can fall in value by 40%. Pearl 7 fell over the last couple of years by 15% in value, and we argued at the time it was heinously mispriced and massively overvalued. But those guys, many folks bought $3 billion worth of that Pearl 7 on the basis it was like cash. It was a cash substitute, and it wasn't.
No, it's not.
They lost 15%.
The rate proves it. If the rate's...
Pearl's 8, my friend, the treasurer of CBA, Puilo, is a very, very bright guy, and I respect him a lot.
You're talking to your buddies here. Okay.
Wait a second. He launched Pearl's 8 a month ago, and that's done brilliantly. I mean, that has delivered the buyers of Pearl's 8, this is another CBA hybrid, capital gains of 2 to 3%. On top of the yield they expected. So that's terrific, and that was a well-executed deal. So, just do your due diligence, and it's got to be commensurate with your risk tolerance.
Okay. But one last question. They're trying to wind me up. This is my show. Should we be worried about the housing sector and the banking sector and the economy all in one go? Or is this like, okay, there might be a small problem, but not a big problem?
Yeah, so...
Small problem, a big problem.
Short strokes. Right now, everything's positive for housing, everything's positive for the banks.
Okay.
Medium term, so over the next 3 to 5 years, yes.
Okay, we'll bring you one in 3 years' time to talk.
Thanks, man.
Oh, mate. That's Christopher Joye from AFR. He's got a bond fund as well. What's your fund called?
Smart Money Investments.
Of course, Smart Money Investments. What else would it be with Christopher Joye? After the break, there is a new kid on the block competing with the likes of Western Union. It's a local operator called Wellfirst. We'll talk to the Managing Director, Andrew Porter, to see what this company's competitive advantage is.